I'll restart. Welcome to the Power of Passive Investing meetup, everyone. This is a virtual meetup. We used to be in person in New York, in New Jersey. We're hoping to get back to that at some point in the future. But for now, we're meeting virtually. We leave some time at the beginning for the folks to network and get to know each other. We have a great presenter tonight. It's Stefan Tsvetkov. Stefan is going to share his knowledge about the current real estate market and whether it's overvalued or not. He's going to share the research that he's done personally. Stefan is a financial engineer who works on the derivatives trading desks for a major insurance company. He manages 90 billion derivatives portfolio jointly with a few of his team members. He is in real estate for 3 years now in the multifamily space. He owns 3 and 4 unit properties in New Jersey and a duplex in New York. He is a founder of Envy Analytics, which is an investor-geared property analytics software company, and Papula Equity Partners Group, which is a real estate investment firm. So without any further ado, Stefan, please feel free to take the stage.
Thank you, Alina. Thanks for introducing me and for giving me the opportunity to speak at this event. So with that, let me share my screen and yeah. So just one moment. So do you guys see my screen now? Yeah.
Yes.
Yes, we can.
Okay, sounds good. Yes. So I was going to start with an introduction, but I think Alina did a better job than me. So this is perfect. Thank you so much. And yeah. So the topic of today's lecture is basically real estate valuations. So I did some analysis. So I put like basically governmentally available data pretty much, and did a study on state level as well as counties level. And I was trying to look at, okay, which metrics, if we look at the prior crisis in 2007, which metrics had the highest predictive power. And then my motivation was, okay, if assuming we happen to be at the peak of cycle right now, what are the places to invest, and are there any places to invest where you wouldn't heavily lose money on a potential downturn and things like that, or how much you would actually lose if that's the case. So that was my motivation. So yes, all right, so first, just to start, something you guys have probably seen. So Zillow did a literature review on past pandemics. So they looked at multiple pandemics, but amongst them, 2 of them were the Spanish flu and then SARS. Okay, and so one of the, yes, and in addition, you, as some of you know, the National Bureau of Economic Research in June of this year announced a recession officially, stating that, okay, the peak of activity has been in February of this year. So, right, so the Zillow literature review, what it's found, let's say, or their kind of, partial insight being, okay, other recessions that were not, caused by pandemics, let's say, they had a longer, cycle term. They went over, let's say, 6 to 18 months, etc. Versus in SARS and in Spanish flu, there was a pretty quick jump back in activity. So, I mean, that's just something high level. So I mean, that's interesting. So that could be the scenario now. We are seeing this in retail sales and other metrics already, if you have seen some of those charts. So that's interesting. But that said, I wanted to make a comment from public real estate, right? So with public real estate, as most of you know, okay, with real estate investment trusts, most people would think, okay, there is a significant commercial component in most ETFs over there and most real estate investment trusts. Okay, so pretty much the only one that doesn't have a commercial component is REZ. So REZ is only residential, so it's the pure buildings within REZ, as well as some mortgages, right? So this is the performance as of 14th of August, like about 10 days ago or so. So it was like 23% down, and at the bottom, it was actually 44% down. So now that's why do I include that? So this is a study by Nicole Funari at read.com. So this study is done with data by pension funds. So pension funds, what they did, with real estate investment trust data relevant to pension funds. So what they did, okay, if you actually try to correlate the returns of public and private real estate, and if you don't, they lag, essentially, you would see pretty low correlation. Okay, so it's going like 8%, right? It would be super low. Now, if you do it properly, if you lag, right, and for the exact same assets within that ETF, this correlation would be 91%. Okay, so that's normal. That's what intuitive, let's say, we would expect that, right? We have the same underlying buildings, so we would expect private real estate and public real estate for the same buildings, the two to behave together. But that said, we see, okay, in public real estate, there is a bigger downturn. So if you look at, for instance, in this graph here, so the FTSE Nareit index, that's the stocks. That's the stock market. That's the public real estate. So you see it has a big downturn, like it really drops much more, okay? And then NCREF, this is one of the main issuers of private commercial real estate indices. So it's much smoother, it drops less, you know, etc. So that's partly what we're seeing here. So now public real estate is dropping heavily because, okay, that's what happens there. There is a bigger reaction. Okay, private real estate is smoother, but can we expect to have no effect at all? Probably no. For the same assets in REZ, we would expect to have a certain downturn there. Now, that's it. I will look at valuations in a moment, and we will see it is, I would say, milder. So it's, I don't think it's something, you know, particularly concerning, but still, it's some information from the stock market. In addition, as we know, the stock market is pretty much the most efficient market, right? Now, you don't have another market with nearly the same liquidity and market participants. So to totally ignore it, you know, just to say, okay, the stock market information, this is just sentiment and it doesn't matter, I think it's not right. Because in the end, we have, you know, we don't really have any better joint information by multiple participants or a more efficient way to collect it. So, so that is something. Okay, so now with that, just moving on to like just what happened in 2007. So in 2007, I mean, most of you, you know, have been probably investing then potentially, or maybe not, or at least have been aware of what the drops were. So those are the drops that happened in 2007. Now in 2007, we all know, okay, California was hit hard. We have Nevada, Arizona, there was Michigan as well, Florida, etc. But what's more interesting is that not all places actually dropped. So why is that? What is driving it? So that was like some of the motivation of this lecture. So if you look at 2007, so the biggest drops, okay, Nevada, Arizona, Florida, California, etc. But in North Dakota, the drop was 0. And that's, so this data is Federal Reserve Bank of St. Louis. I was looking at another data source, let's say Zillow, and Zillow is the most price sensitive, by the way. And North Dakota, 0 again. Okay, so 0, no drop there. South Dakota is minus 3%. Here in Zillow data, it's 0%. Okay, and etc. So all the states to the right, pretty much the drop is, I would say, very insignificant, right? Up to 5%, it's not a huge deal, like on the state level, right? So that's interesting. So what drove that? So one thing I was thinking initially, I was thinking, okay, it may be driven by volatility. So I did some volatility studies, and this lecture here is a briefer one. So I'm not gonna go on that, okay? But initially my thinking was it's driven by volatility. So I was thinking, okay, there are states that are inherently more volatile due to foreclosures, for example, being one of the factors, or percentage of foreign ownership, etc. So then here, the top foreclosure states. So in the recent 5 years, New Jersey is consistently the leader. Then we have, okay, Delaware, Maryland, Florida, and Illinois. Okay, so my original thinking was, let's look at volatility measures, try to find like risk-return performance, risk-return dynamic what has been in different places, etc. And that maybe my thinking was, okay, New Jersey probably may have a higher drop due to being a foreclosure state, Delaware, etc. Those places may be more affected. So that was the original thinking. Okay. Now, what has been the market performance post the drop in 2007? So the best performers, as some of you know, are Colorado and Texas, right? Colorado and Texas. From there, we have Idaho, North Dakota, South Dakota, and let's say Utah, right? Those are the best performing markets, right? So everybody knows Texas, population there grew by 40%, and it's the biggest state, 40% since 2000 population count, or 39. So it's, it's enormous growth, and Colorado has had a big population growth, etc. So those were the best performers. On the contrary, we have Northeast, very sluggish, right? There is a slowdown in population terms. Their incomes are growing in a fine manner, but overall, Northeast price performances have been much more moderate. And then there are some states that have struggled a bit, like Illinois, etc. So again, these are the best performers to the left and worst performers to the right. So Connecticut, Maryland, New Jersey, the very three worst performers. In this cycle since 2007. So this is 2007 peak until current, right? So just trying to account for, okay, a long-term trend in prices. So not just, let's say we have Florida prices increased, okay, we have Nevada prices increased 120% since their bottom, but in fact, Nevada is flat. Since the previous peak, so etc. So just trying to catch the long-term trend. Okay. So then at the cities level, the best performing cities. So very much cities in Colorado and Texas, not surprisingly. Also Nashville, San Francisco, Washington, as well as Durham, North Carolina. And then to the right, we have some cities in California. California is very interesting. It has some of the very best performance in city space and some of the worst. And it has also a huge number of cities. California, as some of you know, has the biggest count of cities in the top 800. So I think they have nearly 20% of the cities are only in California. So that's something to consider. Right, so they have some cities that performed really well in this cycle and some that didn't and are at the extreme. So they're in the list. And then some states that actually have troubles. Some of the foreclosure states appear here. So we have Florida, Nevada, Maryland, Illinois, and even Arizona, I believe, is a top 10 foreclosure state. And that's so that has been the performance. Now, another thing, just quickly to comment. So one of the things, like when we investors speak of real estate market not being efficient. So efficiency, like in theory, like in financial theory, has three definitions. So the least, so to say, definition of efficiency is weak form efficiency. So weak form efficiency, in it, the information set that determines efficiency are historical prices. Right? And in that, the best test for that is autocorrelation. So autocorrelation is basically, is there a trend? So that's interesting. So this is just a study I did myself, a 1-year lag, autocorrelation. That's how it looks in different states. So if we have Colorado, for instance, where prices have been exploding and has been the best performing state, if it turns out that now we're not at the peak, Colorado is, with 71% correlation, may have last year's performance. So if the cycle continues, things are going to be quite correlated. The only place that is actually negatively autocorrelated is Alaska. So that's pretty interesting. But everything else is like quite correlated. And there are several places where you would not have this dynamic. So in Montana, North, South Dakota, you would not have this. So if you invest there, you may not, even if the cycle continues, you don't know exactly, like, you wouldn't have this degree of dependency versus where prices, how prices developed the previous year. Okay, so from there, this is a study by Niraj Shah. So it was published at Visual Capitalist. That I'm not sure if you guys have seen it. So that's showing, was it in the middle of 2019? So it was showing which countries are most overvalued, and the specific map here is by price to rent ratio. So we can see actually US not looking too bad. It's only 110. So 100, let's say, would be, you know, perfect, like fairly valued. US only 110. But then on the contrary, Canada and Scandinavia, as well as New Zealand and Australia, actually quite overvalued. And then UK is at 144, also somewhat overvalued. I would say like this kind of price rent is a bit tricky. That needs to be adjusted for interest rates generally, but still like something to look at. So that's just a picture of where I think it's a good study where I think, yeah, so we can see, okay, where does US stand currently compared to other countries? Okay, so then just like the case for valuation metrics is coming from finance. So in finance, maybe some of you know there's price earnings ratio, right? So price earnings ratio is telling us, okay, since stocks are valued on their earnings or in corporate earnings, right? Okay, is the stock market overvalued, or specific stocks are they overvalued, etc. But now this is, if we look at price earnings trailing 12 months in this table, it has 76% correlation. Let's say if it's overvalued with negative 76% correlation, what will be the subsequent price performance in total return space, let's say. And so this is for price earnings. Right, but then some people have developed even better metrics for that. So then there is, let's say this is a study by a hedge fund. So John Hussman, so he's a PhD, he has done a study and he has developed one of his metrics, non-financial market cap corporate gross value. It in fact has 91% correlation. So this is the kind of study that I try to do here, right? So similarly, what would be the most predictive measure for real estate for the subsequent drops, assuming we're at peak. So we don't know if we're at peak, the market can continue for longer, etc. But this was the motivation. Okay, so what I did, so I tested different metrics, and as I said, I was initially going like risk return space, studying volatility, things like that. Okay. But here, this is the following methodology. So this is valuation based on historical price income ratio. So it's really simple. So the deviation of a historical level. Let's say the historical level, I test which one gives the highest correlation, which one has best correlated to 2007 drops, and just a trailing window compared to the different periods in the different peak dates, let's say in different regions at the state level or the county level. And this metric shows 83% correlation. So I thought that's amazing, because to me, okay, that means I can get something that can actually show me, okay, where can I invest, you know, and not lose money, assuming we happen to be at peak of cycle. So it has shown 83% correlation versus subsequent actual price drop. So what this means is, if we have, for instance, yes, so let me show you like a table. So the most overvalued markets were, okay, California, Florida, Arizona, DC, Nevada, etc. So if you have, for instance, in Nevada has shown like a 49%. So it's not a perfect fit, by the way, right? But it's we have, okay, Nevada 49% overvalued in 2007, and the subsequent actual drop is 56%. Okay, and then we have one region which is, you know, not a state or not yet, DC, which is, okay, there it hasn't actually corrected, and even until now. But that's kind of this can happen on a small region level, but it doesn't seem to happen on the state level, nevertheless. So within like a city or something like that, this can happen. And okay, so here, if in each state, the peak happened on a different time. So let's say it may have been in, you know, July, like second or third quarter of 2007, or in some regions, it could have actually lagged quite behind. If you look at North Dakota, it never dropped, and the peak was, I think, like 2010 or something. So it's just like was a different dynamic. So a different peak date, then the subsequent drops that happens, and drops actually, I think, I'm not sure if I have it here included, drops took on average 4 years and a quarter. So that's how long it took for markets to reach their bottom, actually, on the state level. And that drop within those 4 years and a quarter is like 83% correlated with where the valuation was before that. Okay, so that's for overvalued states. So they were, let's say, median 26% overvalued, and the median price drop was 22%. Now, what was most, for me, the most interesting thing is, okay, what happened to undervalued markets? So here is the list of undervalued markets in 2007. There were very few. So most markets were either fairly valued or overvalued then, but these are the undervalued markets. So the drop in undervalued markets was 4%. So to me, this was the most important finding, because to me, this means, okay, you can have business continuity. Okay, you're doing, let's say, a syndication, or you're doing like individual real estate investment, whatever. This to me is telling me, okay, if we happen to be at peak, or if we have, okay, we have a pandemic, or, you know, different kind of macro event, you know, that triggers, you know, the peak to happen and then a drop subsequently. Okay, that can, one can have business continuity and can have actually, you know, places where one can invest and not see much of a drop. Now, what's interesting here is, so the average drop that happened was 4% across all undervalued states. So 4% was also the average income drop in US post 2007. So what that means is that wasn't even a drop in valuation terms. So valuations, high level speaking, they stayed the same. So we have the biggest crisis in history, right? We have 2007, the biggest crisis in history, and that has some financial engineering in it. It has mortgage-backed securities, things like that, right? So one would think this is a different, you know, even back then, you know, everybody thinks that's a different crisis, etc., which it is. And it is indeed the biggest one. And yet, if a state was undervalued, this state did not drop on valuation. No matter what the crisis is, what is happening in other variables, etc. So the only drop happened at income, so 4% according to income. So that was quite interesting. Okay, and then where are valuations now? So that's what you know, mainly we want to know, right? So the current market, high level, I would say, from what I see, is based on this study, under to fairly valued. But there are some markets, and some of them are pretty hot markets, that are actually overvalued. So which are the overvalued markets? So you can see on the map in dark blue, we have Idaho. So Idaho is the peak overvalued state right now. And the rest being DC, Nevada, Colorado, Arizona, Florida, Texas, and Washington. So these are all states that they have a valuation, let's say, more than 10% overvalued. Okay, and right, and then the drop projected, by the way, don't hold me to that too much. So this is this uses a regression. This uses a regression based on 2007 levels. So 2007, where valuations were then, the regression coefficients from 2007, and I mean where valuations were, what drops happened, the coefficients from there, and these are the drops that we would see. Now, these drops, of course, if we're not at peak, they're not going to happen at all, right? We can continue for like 2 years, 4 years, etc. But assuming we're at peak, what this study is showing is assuming a peak from each peak that is different in different places to the subsequent bottom. So that's not going to be even overly painful, but let's say the subsequent bottom can be several years after, you know, 3 years after, or 2 years, or maybe 6 years after, right? So those are like some drops that could happen, assuming we're at peak. If we're not at peak, the market continues, and etc. But sooner or later, you know, some correction, I mean, some resolution for the overvaluation does happen. Now, another thing is in 2007, so that's why, let's say, that would be these projected drops, because 2007 was a correction scenario. So pretty much, and that was too much information to include here, but I have a study on counties level, and it shows, okay, how many counties corrected. And pretty much like 90–95% of counties had a correction in 2007. So it wasn't, was pretty much a correction scenario. So another scenario is, let's say, income may grow super much. And, you know, our prices have some reduced growth. And let's say over the longer run, over, you know, 15, 20 years or whatever, or 10 years, you know, some of the overvaluation resolves. Okay, so that's, now, another thing that's interesting, the overvalued markets. So which markets were overvalued? So to the right, we have some account for peak to peak, okay, because that's assuming a peak, but let's say peak to current price performance. So these are either markets that, okay, they are some of the best markets. So here we have literally the, what is it? Colorado, Texas, Idaho, and DC. I think these are the 4 best performing markets actually in peak to current performance. So we have some of the best performing markets, which just, okay, they have done amazing. They're the best, but they have gone slightly undervalued. And in Idaho's case, a little bit more. And then there are some states that are actually weak, that like Nevada, Florida, and Arizona, okay? So their performance, they have been almost flat versus their previous peak, and yet they're overvalued. Okay, that also makes sense, right? Because these are pretty much foreclosure states. These are states that have trouble. It's like people really like to invest in Florida, etc. But if one looks at price performance in Florida, how they recover from crisis, things like that, it's not a robust market. It's a market that is more volatile. It's a market that also tends to be fraught. It tends to get overvalued frequently. So those are some things. So Florida and Nevada and Arizona, they have had weak long-term trend, weak long-term performance, and yet they are overvalued. Okay. And so then just one moment. Yeah, and now what are the undervalued markets? Now most US states are undervalued. So I'm not sure what the count is here. I didn't include fairly valued, you know, just to brief on it a bit, but basically undervalued, it's maybe like 27, 28, you know, like close to 60% of the states are undervalued, in fact. Now there are some that are close to fair valuation. If a peak happens, fairly valued things may correct. So that's actually what happened in 2007. So they can see some drop, even though they're fairly valued. And then with undervalued, we saw that's much more difficult. Now, so a note on market selection. So in this framework, so this table is showing markets that, okay, they're still undervalued, but they did really well. Okay, so we have, for instance, let me, because I don't see it. So we have, for instance, Kansas, Indiana, Oklahoma. They have had strong peak-to-peak performance. You know, they're over 25% above the previous peak. And yet they're still undervalued. So, I mean, short of other factors in those markets and what population projections, et cetera, purely in terms of if we, let's say, look at the autocorrelation studies, right? They support, you know, some dependency versus past performance. So that's, those are states that, okay, we would expect, you know, they're not going to correct much. And if they have continue to perform well, those are good markets to invest in. Okay, then I did the similar study at the county level. So just a quick mention. So that's the data has 2,700 US counties. So at the county level, the similar regression shows 73% correlation. That's much weaker, I would say. So now 73 versus 83 is like much, much worse, I would say. And it's even can be seen like even in the absolute terms of the numbers, etc. It's not such goodness of fit, so to say. But still, these are 2,700 US counties. You have every tiny region, you know, fairly small region in US. And still, the drops that happened in those small regions was quite predicted by purely like income, just income. And by the way, I want to say something that if we look at, for instance, Nevada, like, because Nevada had some of the biggest drops in, one of the biggest drops in 2007, Nevada dropped 56% in this data, in Federal Reserve data, and like over 60% in like zero, etc. So it's quite interesting because Nevada population, as some of you know, has been exploding for 2 decades. It was exploding in that decade as well. So in 2000 to 2010 decade, Nevada population was exploding. And it continued to be exploding, and yet their correction was not predicted by their population growth, again, was better predicted by price-income ratios. Which is why I kind of advocate this measure, because it's just like I test it, you know, like other, you know, I know like all syndicators, they pick their market, they look at, okay, what is the population there, what is the job growth, things like that. Yes, that may be in a normal, like sort of intermediate price cycle, that works okay, but once a peak is reached, that doesn't matter. So pretty much, so valuations are what drives that at the peak. Okay, so that, so I think I'm like probably a bit forward with time, so I'm going to like go a bit quicker. So this is at cities level. So these are the current valuations for US cities. So those are some the most overvalued cities. So based on what we saw before, not surprisingly, we have Boise, Idaho at the peak. So Boise, Idaho is a popular market with some investors. It's actually very overvalued right now. And then we have Las Vegas, Tampa, Austin, Washington, Fort Worth, Phoenix, and Nashville are some well-known cities that are actually overvalued. Okay, so these are the most undervalued cities. So the most undervalued cities, Chicago, Cincinnati, Baltimore, Greensboro, Memphis, Pittsburgh, Louisville, San Francisco are some well-known ones. So those, some of them just because of pure price performance, and some of them, okay, maybe they performed well, but they're just still undervalued. So that, and then here are some, actually to that point, some of the best performing cities that are still undervalued. So one thing that's interesting, the very best performing city in America was Denver, Colorado. So out of 800 cities with more than 50,000 population, Denver, Colorado performed the best, peak to current, since 2007. So they're 79% above the peak. What's very interesting is their incomes grew just as well. So everybody would have the sentiment, if I was living in Denver, Colorado, would have the sentiment, okay, that must be an overvalued city, but it's not. So Denver, Colorado is in fact at zero. It's like minus 0.3% valuation, something like that. And so it's fairly valued, in fact. Okay, some other cities that are not overvalued that have performed quite well. Well, in fact, San Francisco is in the list. So everybody is raving San Francisco is super expensive. Yes, it is super expensive in absolute terms, of course. Also, their I mean, I'm sure their price to income ratio is much higher than, of course, in other places. So yeah, real estate there is always expensive. But is it more expensive than its historical level? No, it's not. It's in fact slightly undervalued. So that's the state in San Francisco, and then Pittsburgh, Omaha, Columbus, Indianapolis, Atlanta, Louisville, Philadelphia are some other big cities that have done really well and are nevertheless undervalued. Okay, so just a quick mention for like what has been discussed. You know, what is a trendy topic in terms of population shifts and like moving from cities to other places, like you know, it's suburbs. And so this is like Redfin study. Most of us have seen this. So this is okay from New York City, where some user statistics where New York City users are searching, you know, for what kind of places. So let's say Atlanta, Georgia being at the peak. So, and New York City has a percentage of users who search elsewhere of what, like 36%. So that's interesting. And these are some of the states that have grown the most in population terms. So we have Nevada, Utah, Texas, Arizona, Colorado in the lead. So, and then we have some of the low-income states like West Virginia. West Virginia, for instance, is there. It's at the bottom, and then also like just some Northeast. Northeast, you know, has had like not good population growth. So we have Rhode Island, New York State, Vermont, etc. So that has different components. One of the more looked at components is domestic migration. So people have been moving out of Northeast, Alaska, Midwest, Hawaii, Kansas, New Mexico, and into the West, except California, and Colorado, Texas, Florida, and North and South Carolina. Okay, and this is how incomes have grown. So they have nevertheless had a slightly different trend. They have grown more in the parts of Northeast and the West, where California, and that has partly kept the prices in those places. So population has been moving out, but okay, in domestic terms, but there has been some foreign migration and there has been some income growth. So that has superior income growth, and that has kept the prices to an extent. Okay. So yeah, so just as a concluding thing for this topic, so in finance, price earnings ratios are negatively correlated to interest rates. So this is a study at suredividend.com. So it shows, depending on which P ratio is used, let's say 65 or 53% negative correlation, and seen also in the graph. So based on this, so if I did the current study, okay, if I did the current study and I showed I showed, okay, Idaho is 22% overvalued. So is this correct? Now, some people say, so I was speaking to like a friend of mine in commercial real estate, and like he's somewhat on the technical side, let's say. And so he was saying, okay, what does it even mean, like a market to be overvalued, especially in commercial space? Okay, because it's driven by, what does it mean? Cap rates are compressed or things like that, right? And it's, you know, that would be the usual measure people speak to, actually. I don't think it's a good measure, by the way, but that's the usual measure in commercial real estate that people speak to. Okay, are cap rates too low? So maybe that's why the market is overvalued. Okay, but then if cap rates are too low, that's based on interest rates. And that was, he was making a good point. So that's based on interest rates. So how does it matter given interest rates have been dropping for 40 years already? So we're at the very bottom of interest rates for 40 years back, since 1980. Now they're gonna get even less, right? But how does it matter, you know, for cap rates? Given, okay, it's just driven by that, you know, how does it matter for valuation? So to say that cap rates are low because it's just because interest rates are there. Okay, so I did a quick study. So the blue line here is actually valuations. The same valuations I'm showing in the previous charts that I computed based on price income ratio. In orange, we have the history of US Treasury 10-year rate. So as I mentioned, on the 40 years of downward trend, the nominal rate, okay, the real one is also on a downward trend. And so we have that. And it's quite interesting, though. It's like really going down, but as you can see, valuations, price income ratios are actually pretty level. So they don't trend the same way as cap rates do. And if we were to adjust, let's say if I was to adjust valuations for the US, the current valuation is 5.75. So price to income ratio of 5.75, okay? If one adjusts it according to the 10-year rate, according to where interest rates are now, that would become 589. So actually it's a higher valuation. So that's pretty interesting. And it's interesting that price income ratios have shown, in fact, positive valuation recently. Now that has been like closer to zero in a slightly back period, but it's not a negative valuation like in finance. It's not where we see, okay, negative 65, negative 53% correlation versus where valuations stand. So that's pretty interesting. So that means, okay, if we have Idaho at 22% overvalued, it is actually just the same, still 22% overvalued, even though interest rates are super low. So that, and with that, thank you very much. And that's everything for today. And I'm open to questions.
Stefan, thank you. That was very insightful, tons of data, a lot of stats. Very, very interesting movement points. Guys, feel free to either unmute yourself if you want to ask a question or post it in the chat, and I can ask Stefan if you like.
Hi, this is Johnny. Can you guys hear me?
Yep, we can hear you. Go ahead, Johnny.
Hi, Stefan. Thank you for the presentation. I found the valuation, the figures interesting. But given that we, primarily in New York, New Jersey group, and of course real estate local, do you have valuation figures for the New York City area?
Yes, I do. And actually, yeah, I can send you. I did a bigger presentation at my own meetup event that I can send to you actually. So that has some more details for the Northeast. So that has some of the charts, how they work in different counties, things like that. So yeah, you can see that's pretty interesting. Well, it's undervalued. Big picture, I can tell you the answer. It's undervalued. So New Jersey is, so like I said, like, okay, New Jersey is a top foreclosure state, for instance, but except Hudson County that is slightly overvalued, like 2% or so, or fairly valued, I would say the rest, I don't think the rest can drop much. It's not possible because the rest is super undervalued. So there are like counties in New Jersey that are like 50–20% undervalued. That makes some sense because if you look at like some of the performance charts here, New Jersey had like such poor performance. So yeah, so it's a state that is sort of weak, but it dropped more than New York State in 2007. But this cycle, it's not gonna drop because it's not gonna be possible because it's way too undervalued. And we see like New Jersey was like top 3 worst performer in America in price terms.
Yeah,
so they
sorry,
already realized some of its weakness.
I'm based in Brooklyn, so I was more interested in New York City.
New York. Okay, I'm sorry.
Yeah,
well, okay, sure. Yeah,
yeah.
so Brooklyn is 6% overvalued currently. I can tell you off the top of my head. So it's
okay.
Yeah, but that's I would say it's just Brooklyn is just fine because Brooklyn was heavily overvalued in 2007, but Brooklyn is a bit of a what they call an income supergrowth state county, let's say. So that incomes there have grown so much that even if it goes like, so there was like so overvalued 55%, the correction was only 14% in Brooklyn. The incomes continue to grow. Incomes dropped everywhere in America, and in Brooklyn they didn't drop. And so it's a different dynamic. So Brooklyn is 6% overvalued now only, not much. But I would say for another place, if that's somewhere in Indiana or somewhere else, I would be thinking, okay, it's going to be a drop from that 6% valuation. But in Brooklyn, I don't think so. It's probably going to be fine. It's just a very, very strong market in income terms. Mm. Yeah, and overall, yeah, so New York State is interesting because New York State, right, has very big outflow. So in a domestic migration, where is it? Just one sec. Yeah, like in domestic migration, if we look at it in the chart, New York State has -7%. It's like among the very worst states in the country, like the most place where people are leaving and going to other places. And that said, incomes are among the best though, or have grown really well. And that has kept the state, and also some of the foreigners, you know, you have like, oh, you know, people from Asia and other places who want to live there. They don't want to live in, you know, Indiana or somewhere else. So that's, I mean, that's kind of obvious maybe, but that's for there. So yes, some of the upstate New York counties have done really well, and they have very solid valuations as well. And some of the counties closer to New York City, the suburbs have done poorly. So the suburbs have done the worst actually in New York State. And well, the second worst. So the very worst is like slightly after the suburbs, like counties like Orange County in New York State and things like that have done the very worst. And then the suburbs have been the second worst. So people have been paying a high price in the suburbs, okay, thinking maybe they're going to get a better price performance or things like that. And it's not the case. The same thing happens with investors like me in Hudson County, New Jersey. So Hudson County, New Jersey has not had a great performance. Now it has had the best performance in New Jersey, given it belongs to such a weak state. But still, it's you know, it hasn't been particularly strong. So yeah, so New York State, upstate New York, it looks very strong right now, I would say. There are a few overvalued counties, but overall it's very strong, and price performance have been strong, etc. Has been strong, so it looks good. And New York City, I mean, yeah, New York City is always amazing. I mean, Manhattan has weaknesses, that's seen. Manhattan is negative since 2007. Actually, peak to current is negative, I think like -6%. But that's only Manhattan. The other boroughs are like exploding. Like you know, Brooklyn is like 40% above, etc.
So do you think the current migration that's happening in New York right now is only impacting Manhattan only? It's not impacting the other boroughs where people are leaving and going to New Jersey, right. Connecticut, Pennsylvania? Right.
Yeah, I don't know. Maybe I don't have too much. I haven't studied it that closely, like what drove the Manhattan weaker performance, so to say. I think it's Manhattan is having some actually probably affordability issue or something, because all the other boroughs really did way too well, and yeah, there it seems to be actually maybe it's expensive for people or something. I don't know if it's. I wouldn't think it's driven by the population, because most foreigners then they go there. I would, if one looked at it for, I can look at that actually. I have some of the data at counties level, so I would think Manhattan probably looks good because they have all the foreign influx. So I think they are probably like really not affordable right now, and that's what's driving it. Otherwise, yeah, bigger picture. I don't know if people are going to like on that Redfin chart, if people are going to live in New York City. Yeah, those kind of like doomsday scenarios for New York City, I think it's completely possible. I mean, that said, domestic migration is just one component of prices. It's not like super clear. Is it going to, even if like people heavily move out of, even if they heavily move out of New York City, how big is going to be the impact on prices is not entirely clear. I mean, it
Yeah.
appears it's going to be like some kind of doomsday, but I don't know.
We have yet
And
to see
commercial
that.
real estate is heavily affected, right? It's very bad, and
we've yet to see the full
difficult to
impact,
predict,
I
I would
think,
say.
but I think it's still, the migration is still continuing. People are still living, and not just New York City, LA and other areas. I mean,
absolutely, yeah.
it's impacting all
and
of
it's
the
going to be
world
worse
cities.
now. So it's just going to, I mean, the trend has already been for 10 years, and it's just going to increase. It's going to be even worse, I think. But again, in those terms, in terms of to predict the drops, I think it's difficult. And because here you see at counties level, it's very difficult to predict drops. I mean, correlation is okay, 73%, but it's only that. It's not that. At state level, it seems very easy. Honestly, like I trust this like super much. Like here on state level, if we reach peak, that's roughly what's going to happen. Like what I was showing on these slides. And on counties, no, because on counties, we don't know. There can be like this kind of thing, like people move out from New York City to somewhere else, and you don't know. Like it's a very small geography.
Stefan, I've got some thoughts on this.
Yeah.
So first of all, I wanted to just compliment you on the wealth of data that you analyzed here and put together.
Thanks, sir. I appreciate it. Yeah.
You know, it's very well done. I mean, it's thoughtful. And then there's this. So there's the data, and there's the data that's analyzing it sort of in a certain context, which is the time frame, and some the assumptions around things.
Correct.
And then you get to, so what we try to balance all this stuff with, at least in my head all the time, because you said something that's critical, which is we don't know, right? Which is this idea of the crystal ball. Like it could happen, the doomsday scenario for New York and others. And even in an earlier chart where you showed San Francisco's still quite a good place to, in terms of valuation.
Right. Yeah.
I mean, my personal bias, then you have to start to really kind of get to what is your religion on this stuff, right? What do you really think is what are the end migration patterns going to look like? Where do you really think things are happening? What are the regulatory environment? What are the other kinds of things that are driving a lot of this? And, that's the context that's harder to fit into this, because if you just go with this analysis, I can pick certain spots and say, yeah, that makes sense. But then when I really go to my heart of hearts and think about, well, what's really happening in, let's say, America, right? We're really just looking at America here. What's happening in the lower 48 and what's it going to look like? I've got some real opinions about that. And then, and even in various states, you look at a state like Nevada, I can tell you for sure a place like Reno, Nevada is very different than what's going on in Vegas, right? They're just very different. They're almost two states. So it's really interesting. The other thing, and I guess one of the things that I always think about in terms of real estate is the idea of real estate. There's the valuations of the underlying asset. And I don't know how other people think about this, but there's the underlying asset itself. But really, as investors, in many cases, actually in most all investing, particularly what we do for syndication purposes, at least in our business, we think about the real estate as nothing more than the capital equipment that powers the business. And the business is actually in the business of renting something to somebody, right? You're essentially, and then in the context of that, the most important thing becomes the health of the business. In other words, is the income after the expenses, are you cash flowing essentially? Because if you're cash flowing reasonably well, have solid debt service coverage, all that kind of stuff, you can actually have a very healthy, tax efficient, wonderful little business that may not have the appreciation you expect, but then appreciation becomes less of an issue for you, and then ultimate valuations just become part of the rationale.
Absolutely.
Part of the rationale for the investment, right? Because timing and all this is really hard, right?
Yeah, no, I completely agree. I mean, I would say, let's say this kind of analysis, I would say is one of three components. So the other two being what you're suggesting, let's say having some inefficiency at time zero when you're buying an asset, okay, having some price discrepancy, okay, and having value add, what people call value add, right? Okay. And then, so that's the other component. And then the third one being, let's say, your surplus cash flow or stuff like that. But yeah, absolutely. This is just the market. But again, there is also the aspect, let's say, okay, you can be like, okay, let's say I had like some good deals in New Jersey, okay, and they have like very good inefficiency, etc. But okay, but if I was doing the same thing in Texas, okay, I would have maybe the same deal, but also the market would be heavily supporting. It's still a good benefit to have, and I think it's still good to go in the right areas, because I mean, again, like the way, let's say Idaho is a super hot place. I mean, if people, I would envision if I don't do this study, you know, I can go and invest in Idaho, you know, it's like, it's a popular market, it has done really well. And, you know, so this is, yeah. But the other thing I wanted to say, like, just because you're saying it's hard to predict, actually, I'm not saying it's exactly hard to predict, in my opinion. I think it's hard to predict only small geographies. Again, I want to repeat, I think, let's say like bigger picture, let's say which state and things like that, it's actually not so, it's hard to predict the timing, we don't know the time. But the drops, it's not so easy to, not difficult to predict, because I think even if all kinds of patterns of domestic migration happen, and we see already New York State is at -7%, and maybe it becomes -15% or something, like heavy outflow, right? What I'm seeing is that at peak, valuations drive the drops. It's not all that other stuff. It's not where population is going. It's not all that stuff. So places that people will be moving out of, if they're undervalued, they're not going to drop, even though people are moving out of them. Because this is real estate. This is not like a penny stock or something. The people who have like their houses, they would keep holding them and etc. Now, of course, then the growth from there will be affected. So things will be weaker and that market will be weak. And that's what's happened. That's how Connecticut is weak and New Jersey is weak, etc. But now that Connecticut is already weak and is super undervalued, and I know Connecticut is like, I don't know, 15% undervalued or something, it's already all that other stuff, whether people move out of there, etc. If it's at peak, it's not, one will not be able to predict based on that. It's not gonna work. It's again gonna be driven by, if it's undervalued, it's not going to drop. This is actually what I believe. Even if people move out of there super much.
Yeah,
So
this is a great, I think you're right. This is like a great hedge. This is a great hedge against, it's a good risk hedge, right? To understand where the
exactly.
flow is.
It's only, exactly. It's only that. Yeah, it's not, this is not for, okay, in a good, I would say if we're, let's say at an intermediate, if I believe we're at an intermediate point in the market cycle, let's say, you know, it's 2016 or 15 or something, you know, I wouldn't think this is not going to matter at all. It doesn't matter. It doesn't, it's not, maybe even Idaho being 33% overvalued, it's not going to matter. Because people are just going to, you know, they're going to continue buying. You'll see the autocorrelation, how high it is. Yeah. And that's what's going to happen. And it's going to, you know, be driven by the things that you mentioned, where people are moving, where jobs are happening, and, you know, things like that. But at peak, no, because again, I want to repeat that Nevada population was booming just as hell in Nevada in 2000 to 2010. And it dropped 60%. Why? Because that's the metric that predicts the best, in my opinion. You know, I was looking also at population, I was looking at the other stuff. I'm not able to predict 2007 drops by that. Yeah. I try to correlate where population, we can try domestic migration. So the same thing in 2007, domestic migration, where people are going. Try to relate that to what exact drops happen. It's not going to behave well. It's not going to work. It's going to be what, 12% correlation or something. No, yeah, a joke. So I'm just saying that's just my perspective. But again, you're completely right. This is just more of the risk management side.
Sure, yeah. Stefan. No, this is great. So, Stefan, for those that would like to do their own research or due diligence, are there specific sites or stats that you would recommend checking out?
Yeah. Yes. So first, if you guys. I can put in my email or share it with Alina if you want to, like, actually Alina has the slides already. So if you wanted to get the slides for that. And second, here I include actually the sources. So this is just, because most of the work I do, by the way, myself in this kind of data stuff is on the property analytics side. And that's actually takes me a lot of time. And there, like, I have to write codes and things like that, right? It's difficult, like getting all the data, etc. But this is publicly available. So this is at the county's level is FHFA, the price history, so you can use Zillow or whatever. And then the incomes is just Bureau of Economic Analysis. So I would say to reconstruct this study, just these two sources, and at the county level and at the state level. And that's all that one needs, actually.
Okay, and I mean, Stefan, you're okay if I share the slides with everyone here?
Yeah, absolutely. Yeah, of course, of course. Great. And Yeah, and then population, etc. I mean, that's just census, like again, just the governmental data. So yeah.
Stefan, you
Okay.
actually showed some data, I think, from Fred, right? The federal.
Yeah, that I used.
That's pretty good sometimes. That has some interesting data. It's easy to use anyway.
Yeah. That I used at the state level. Honestly, I just started with it and I kept it. You could use FHFA for consistencies with the counties. Kind of wanted to see if it's too different. It's pretty close. It's not overly different anyway. So yeah,
Excellent.
either FHFA or Fred, or you could use Zio as well.
Excellent.
Zio
No,
is
these
best.
are good resources. Good resources. Thank you for sharing,
Yeah.
Stefan. Guys, I will be sharing the presentation as Stefan allowed with everyone here. I will also share the recording with those that are interested. Stefan, thank you so much. If anyone wants to reach out to you, what is the best way to connect with you?
So you can connect with me on LinkedIn, or just, I guess LinkedIn would be the best way. So if you just search my name on LinkedIn, you can add me there.
Alina, may we just simply type our emails in the chat here?
Absolutely.
Yeah, maybe let's do that. Sure.
I'll just do that, and then so anybody that would like to connect after.
Okay, so here is my email address. You can guys write to me. Actually, you can write to me here because I can send you. I have some more slides also I can share with you if you want it for Northeast or other places.
Thank you guys for letting a West Coast guy crash your meeting.
Anytime, Aram, anytime. For you, it's early, right? It's 5 o'clock, so.
Yeah, no, it's still early.
That's awesome. That's awesome. Stefan, it's been a phenomenal presentation. Thank you so much. You've provided a ton of value, a lot of data, a lot of stuff to digest and share. So I'll be sharing the presentation and the recording with those that are interested. And feel free to connect with Stefan or anyone else here. If there are any questions to me, feel free to reach out. You can find me, as Stefan said, I'm also on LinkedIn or through my company, Samo Financial, or Facebook, or Instagram, or even BiggerPocket. Thank you very much, everyone, and I hope you have a great evening. Take care, guys. Bye.
Great. Thank you. Good night.